Hi guys, Justin Moles with the Moles Group out of Intero Real Estate Services, checking in from beautiful Puerto Vallarta, Mexico. Might be thinking, why am I shooting a video on vacation? Real estate doesn't stop. My brokerage, Chris Kelly, who's the CEO of HomeServices of America, which oversees about, roughly 40 brands across the United States, just released his 2026 National Housing Outlook. And normally when corporate sends over a report like this, it sits in an inbox, but not this one. Because this report says something a lot about people in Santa Clara have stopped believing 2026 is shaping up to be the year this market finally stops whiplashing and starts acting normal again. I'm going to walk you through what HomeServices of America, my own brokerage's parent company, is telling agents nationwide about rates, inventory prices, and buyer psychology in 2026. Then I'm going to tell you exactly what it means if you own a home in Los Gatos, San Jose, anywhere else in Santa Clara County. Some of it you'll like, some of it you won't, but that's the way of the world. Let's get into it. Quick context for anyone new here. I'm a real estate team leader with Intero Real Estate Services here in Santa Clara County. Intero is one of the brokerages under the HomeServices of America umbrella, which also includes Berkshire Hathaway Home Services companies across the country. So when this outlook says, here's what we're telling clients nationally, that's not some outside research firm guessing. That's literally the network I work inside of, compiling data from Keeping Current Matters, the Fed, FHFA, NAR, and Realtor.com. Here's the highlight for the cover page of the report. 2026 reflects a market reaching equilibrium after years of volatility. Equilibrium, not a boom, not a crash, just normal. If you've been holding your breath since 2022, waiting to see which way this market breaks, that word matters. Let's break down the normal actually looks like, category by category, and then translate every one of them into what's happening 2 blocks from wherever you're sitting right now. Mortgage rates. Let's start with a number that everyone actually cares about, the rate on your mortgage. The report makes a point I think a lot of people forget. The ultra low rates from 2020 and 2021 were an anomaly, not the norm. Going back to 1990, the 30-year fixed has averaged somewhere in the 6 to 7% range. In 1990, it was over 10%. In 1998, it was still at 6.91%. The 2015 to 2020 window of 3, 4, or 5% money was historically unusual, and the report is blunt that it's not likely to repeat. So where are rates actually heading in 2026? The Outlook's forecast, built off Fannie Mae, MBA, and Wells Fargo projections, has rates sitting in the 6% to 6.4 range for most of the year, with ARM products running in the high 5s. Most forecasters see rates staying in that 6% neighborhood through 2028. Here's a number that actually explains buyer behavior right now. The share of homeowners with a rate of 6% or higher is the highest it's been since 2016. Nationally, FHFA data shows that 80% of existing mortgages are still under 6%, meaning most current owners are sitting on a rate better than what's available today. That's the rate lock in effect. You've probably heard me mention before. Now here's the local translation. As of the first week of August 2026, the national average 30-year fixed is sitting right around 6.65 to 6.8%, depending on the day and the lender you're checking. That's not the 3% world of 2021, but it's also not the 8% scare we saw in late 2023. For Santa Clara County, where the median mortgage balance is enormous compared to the rest of the country, every quarter point matters more here than anywhere else in the world. A move from 6.8 to 6.4% on a $1.5 million loan is real money payment swing, hundreds of dollars. And it's exactly the kind of move the report expects us to see ease into over the next year, not overnight, as everyone expects. Inventory. The next section is the one I think matters most for anyone who's been frustrated trying to buy here. The report calls it the long climb out of scarcity, and it lays out exactly how we got so tight. Over a decade of underbuilding, plus rapid household formation, plus historically low mobility because everyone with low rate refused to move. Everyone's kind of locked in their home. Nationally, Realtor.com data cited in the report shows inventory up about 30% year over year through mid-2025, with early 2026 projections putting supply back around early 2020 levels. Still below the long-term healthy norm, but the tightest years are behind us. There's also a really important psychological shift buried in this section. The report notes that life events, things like births, deaths, divorce, job relocations, and companies calling people back into the office are now starting to override the rate lock hesitation that's kept so much inventory off the market. People are finally accepting they can't wait forever for a 3% rate to come back. Now let's zoom in to Santa Clara specifically, because our local numbers actually track this story really well. Coming into 2026, single family inventory here was sitting around 1.5 to 1.9 months of supply, which is basically a seller's market. By June 30th, Zillow had roughly 31 homes for sale across the country, with about 1,300 new listings added that month alone. And by mid-July, we'd crept up just over 2 months of supply. Anything under about 2.5, 3 months is usually determined as a seller market. Medium time to pending was running around 16 days countrywide as of late June, though average days on market, which counts that properties that sit, had climbed into the high teens and 20s, up from a single digits earlier in the year. We're seeing that across all of our listings currently. Very frustrating, so I'm in that boat with you. Translation, it's still fast here compared to almost anywhere else in the country. 9 or 10 days on market would make headlines in most cities, but relative to our own recent history, we are climbing out of scarcity, the report describes, and the climb gives buyers something they haven't had in a long time, a second look, which we're seeing, a weekend to think, maybe even a little negotiation room in properties that aren't priced perfectly. Contingencies, very rare in previous markets, very acceptable in today's market. Home prices. This is a section I know a lot of you have been waiting for. The double-digit annual appreciation we saw in 2020 through 2022. The report says flatly that era is over, and 2026 is expected to look more like the steadier 2025 to 2019 market. Here's a wild stat from the middle of the section. The report compiled 2026 price forecasts from 15 different research shops. NAR, National Association of Realtors, Wells Fargo, Totality, Realtor.com, Fannie Mae, Zillow, Redfin, Bright, MLS, Moody's Analytics, Bank of America, and others. The average projected national home price change for 2026 is just 1.6%. The most bullish call from NAR, National Association of Realtors, was 4%. The most bearish from MBA was actually negative 0.3%. Nobody in that lineup is calling for a crash, and nobody's calling for a boom. That's about as close to consensus as you can get in this industry. The report also breaks down regionally, and this part is important. The West region, which includes us, is specifically called out for the slowest price growth in the country, following the outsized gains we saw during the pandemic. Meanwhile, the South is still getting the population-driven bump. The Northeast tight supply keeps prices climbing. The Midwest remains the affordability anchor of the whole nation. Seeing a ton of people relocating, Nashville, Tennessee, even if you want to stay kind of west, Idaho, Nevada, and Arizona. Atlanta if you're going east. And this tracks exactly with what I'm seeing on the ground here in Santa Clara County. Depending on which source you check, our single family median has actually moved lower year over year for several months running into 2026, down somewhere in the mid to high single digits in percentage terms, with the country median sitting in the roughly 2 to 2.1 million range through the spring and summer, compared to closer 2.05 to 2.5 million a year earlier, depending on the month and the data source. We are almost to the letter the market this report describes as absorbing outsized pandemic gains and correcting back towards trend. One more number from this section worth flagging if you're thinking about selling. Nationally, home prices are up 48.5% over the past 5 years, according to FHFA. California's first year gain was 35.3%, below the national average. If you bought in Santa Clara County before 2021, you were sitting on real, substantial appreciation. This isn't about losing money, it's about growth rate slowing down from the extraordinary to the ordinary. Home sales. The report's language here is my favorite phrase in the whole document. Recovery in inches, not leaps. NAR is projecting existing home sales up as much as 14% nationally in 2026, though other economists are calling for something more modest, in the 3 to 9% range. Either way, we're still well below the historical annual average of 5 to 5.5 million sales, and nowhere close to the 2005 peak of just over 7 million. Demographically, the report points to three forces at once. Millennials are now at their peak home buying age. Gen Z is starting to enter the market despite student debt, and baby boomers still have the largest share of home ownership in the country, meaning a lot of future inventory depends on when and if that generation decides to sell. There's also a migration note that matters for us specifically. The report says high-cost coastal markets are stabilizing after the outward migration we saw during the 2020 through the 2022 pandemic. even as work from home flexibility continues at a lower, more permanent level than pre-pandemic. That migration stabilization is something I can genuinely confirm from where I sit. The mass exodus stories from a few years back, people fleeing the Bay Area for Austin or Boise, have slowed considerably. Santa Clara County isn't seeing a sales boom, but we're also not seeing the outbound bleed we saw during the peak of remote work. People are staying, buying trade homes, and in a lot of cases waiting for exactly the kind of inventory relief this report is describing. So why isn't this 2007? I get asked some version of this question almost weekly. Justin, are we heading for another 2008? This section of the report exists specifically to answer that, and the data is genuine reassuring. Combined homeowner equity nationally now exceeds $34 trillion, according to the Federal Reserve. Nearly 70% of owners have at least 50% equity in their homes. Break that down further and it's even more striking. 39.3% of owners hold their homes completely free and clear. No mortgage at all. Another 27.9% have mortgage, but more than half equity. Only 32.8% are mortgaged with less than half equity. And even that group isn't underwater, just more leveraged. Compare that to loan quality. Underwriting standards tightened dramatically after 2010, and recent mortgage organizations carry average credit scores above 740, according to Fannie Mae. Delinquency rates are near record lows, according to Totality, and foreclosures remain far below anything we saw in the mid-2000s. The report's own delinquency chart shows the share of loans 30 plus days past due essentially flat between September 2024 and September 2025. Not meaningful deterioration. There is one wrinkle worth mentioning, and it actually connects us back to something I've covered before. The report notes that rising equity is pushing more sellers above the $250,000 single filer, $500,000 married couple capital gains exemption thresholds, unless Congress changes them, which we do know there's a measure in the House right now. They're trying to make the federal capital gains $1 million, which would really benefit people, Silicon Valley, not so much the Midwest. Cotelli found 8% of the 2024 transactions nationally exceeded that cap, and that share is growing. If you've owned in Santa Clara County for more than a decade, this is not a hypothetical for you. It's a real conversation to have with your accountant before you list, not after. But zoom back out. This is a market of well-qualified owners sitting on historic equity, not over-leveraged buyers, one missing paycheck from foreclosure. Whatever headline you're seeing about the market cooling, this is not 2007, sorry. The West and what to expect next. The report's regional breakdown gives the West 3 specific bullet points, and I want to read them to you directly because they could have been written about Santa Clara County alone. Slowest price growth in the nation. Inventory rising faster, bringing balance back. And quote, tech-driven markets continue to stabilize after volatility. That third line is basically describing everything we've watched happen here since the 2022 tech layoffs started rippling through the country's real estate market. The report also spends a page on lifestyle and design trends for 2026. Rising demand for heat pumps, induction cooking, energy-efficient windows, flexible rooms for hybrid work or multi-generational living, and AI-enabled home security and smart HVAC systems. If you're planning to sell in Santa Clara County over the next year, the top ROI renovations they cite, HVAC efficiency upgrades, mid-range kitchen updates, moderate bath remodels, and energy-efficient windows are the same projects I'd already be recommending to my own sellers here. Buyers touring homes in this country are increasingly tech-forward themselves, and they notice these details. So my take on Santa Clara County real estate. So here's the honest read. Putting the national report next to what I'm actually seeing on listing appointments and open houses this month. If you're a buyer, 2026 is the best window you've had in years. Yes, and we're seeing that specifically even in our own business. Inventory is up, days on market are stretching out, and sellers are more willing to negotiate than at almost any point since the pandemic began. So if you're a buyer, you go in and buy, but then you have to sell. You have the advantage as a buyer, but then you're dealing with the same situation that the sellers are, and it bodes better for the buyers, and that's why days on market continue to last longer, and then those sellers get frustrated as well. You're not going to get a 2021 rate, but you might get a better price, a longer contingency period, and a seller willing to cover a rate buy down, which we actually have one in current contract. They're negotiating a rate buy down and they've renegotiated several times during the transaction. If you're a seller, priced to today's market, not to what your neighbor's house sold for 18 months ago. The report's own line struck with me. Price wisely to the market, not to the headlines. Overpricing in a market where the average days on markets have doubled will cost you more in the long run than pricing correctly from day one. You're still sitting on substantial long-term equity even after this cooling. Just be realistic about the month you're in. And if you're just holding, this report is generally good news. Near record equity, low delinquency, a market normalizing instead of crashing. This is not the 2008 setup. It's a market crashing. It's a market crashing, catching its breath. If you want the full national outlook, or you want me to run these numbers specifically against your street, your comp set, and your equity position, drop a comment or reach out directly. My link's always in the description. I'll break down your specific situation for free, no obligation. Thanks for watching. As always, this is Justin Moles with the Moles Group out of Intero Real Estate Services, and I look forward to speaking to you on the next one.